You filed your taxes last year. You took the home office deduction. Maybe you wrote off your laptop, and you still paid more in taxes than you expected. Here's what's happening. According to the IRS, self-employed workers pay both sides of Social Security and Medicare. That's a 15.3% self-employment tax on top of income tax. But the IRS also gives freelancers more deduction opportunities than almost any other taxpayer category. Most freelancers use maybe 4 or 5 of them. The full list is closer to a dozen. And in 2026, with the standard deduction climbing to $15,000 for single filers and retirement contribution limits hitting new highs, the gap between what you could deduct and what you actually deduct is wider than ever. This video closes that gap. We're going through the deductions that don't make headlines, the ones your W-2 colleagues don't have access to, and exactly how to claim them correctly. Let's start with the category that eats the most money quietly: software, subscriptions, and digital tools. If you use a tool to run your business, it's deductible under Section 162 of the Internal Revenue Code. That's the ordinary and necessary business expense rule. Ordinary means common in your industry. Necessary means helpful for your work. It does not mean required. Think through what's actually on your accounts. Project management tools like Asana or Notion, cloud storage, your accounting software, video conferencing, email marketing platforms, stock photo subscriptions, design tools, AI writing or research tools you use for client work. Every one of those is a legitimate Section 162 deduction. Here's where freelancers leave money behind. They pay for these tools, forget to log them, and then can't substantiate the deduction at tax time. The IRS doesn't require you to prove necessity in a detailed essay, but you do need a record. Keep a simple spreadsheet or let your accounting software auto-categorize recurring charges. That's it. The right move is to do a full software audit right now. Log into your bank and credit card statements. List every recurring subscription. Tag each one as business, personal, or mixed. The business ones go on Schedule C, line 18, Other Expenses. Mixed-use tools get a proportional deduction based on your actual business use percentage. According to a 2024 survey by FreshBooks, the average self-employed professional uses 9 paid software tools for work. At an average of $20 to $50 per tool per month, that's $2,160 to $5,400 in potentially deductible expenses annually. Your number will vary depending on your field. A designer or video editor likely runs higher. A writer might run lower. But the principle is the same: log it, categorize it, deduct it. Next is phone and internet, 2 deductions that almost every freelancer underestimates. You cannot deduct 100% of your personal cell phone bill just because you use it for work. The IRS expects a business use percentage. But here's the thing: most freelancers lowball that number out of caution, and they overcorrect in the wrong direction. My take is this: if you use your phone heavily for client calls, emails, project updates, and invoicing, a 70% to 80% business use allocation is completely defensible. Track your usage for 1 month, screen time data, call logs, app usage. Apply that percentage to your annual bill. That's your deduction. Same logic applies to your internet bill. If you work from home and use your internet connection to do client work, a business use percentage of your monthly bill is deductible. The IRS doesn't publish a specific formula here. The standard approach is to deduct the share that corresponds to business use hours versus total daily use. If you're a full-time freelancer, a 50% to 80% allocation is reasonable and defensible, as long as you can explain your methodology if asked. Your filing status and overall income level affect how much this actually saves you. If you're in the 22% federal bracket and you deduct $1,800 in annual phone and internet costs, that's roughly $396 in federal tax savings, plus your state rate on top of that. Small numbers compound. This is one of those deductions that feels minor until you track it over 5 years. Keep your bills, note your usage basis. That's the documentation standard. Now let's talk about professional development, the deduction that freelancers either ignore entirely or claim too aggressively. The rule under Section 162 is that education and training expenses are deductible when they maintain or improve skills required in your current work. They are not deductible when they qualify you for a new career. That line matters. A freelance web developer taking an advanced JavaScript course, deductible. A freelance writer taking a course on podcast production to add a new service line they already offer, probably deductible because it expands current work rather than switching careers. A copywriter taking a medical coding certification to pivot industries, not deductible under this rule. Here's what's deductible in this category when the business purpose test is met: online courses and workshops, industry conference fees and travel, books and publications specific to your field, professional association memberships, and coaching or mentorship fees tied to your professional practice. According to the IRS, educational expense deductions for self-employed individuals are claimed on Schedule C as a business expense, not on Form 8863, which covers personal education credits. That's a distinction a lot of freelancers get backwards. The data is clear on how much this category can add up. LinkedIn Learning, Coursera, Masterclass Business, and industry conferences can easily run $500 to $3,000 per year for an active freelancer. That's real deductible money sitting in a category most people don't track carefully. One important variation: if you're using the American Opportunity Credit or Lifetime Learning Credit for education costs, you cannot double dip and also deduct those same expenses as a business cost. Coordinate those two strategies intentionally, because the right choice depends on your income and tax situation. Here's where the financial leverage gets serious: retirement contributions. Self-employed workers have access to retirement accounts that are frankly better than most employer 401(k) plans, and the contributions are deductible, not just tax-deferred, deductible. That means they reduce your adjusted gross income before you calculate self-employment tax and income tax. The three accounts that matter most here are the SEP IRA, the Solo 401(k), and the Simple IRA. For 2026, the Solo 401(k) employee contribution limit is $23,500. If you're 50 or older, the catch-up contribution adds another $7,500, bringing your employee side limit to $31,000. On top of that, you can make employer contributions as your own business entity of up to 25% of your net self-employment income. The total combined limit across both sides is $70,000 for 2026. The SEP IRA allows contributions of up to 25% of net self-employment earnings, capped at $70,000 for 2026. It's simpler to administer than a Solo 401(k), but lacks the employee-side contribution that makes the Solo 401(k) more powerful for higher earners. I focus on the financial side of freelance and gig work. This is the single highest leverage deduction available to self-employed people. A freelancer earning $100,000 in net self-employment income who maxes out a Solo 401(k) can reduce their taxable income by a significant amount, enough to potentially drop a full tax bracket. The Secure 2 Act, signed into law in 2022, and with provisions rolling out through 2025 and 2026, expanded catch-up contribution limits for workers aged 60 to 63. Starting in 2025, that age group can contribute an additional $11,250 instead of the standard $7,500 catch-up. If you're in that range, that's a provision worth acting on now. Your deduction amount depends on your net self-employment income, which is your gross business income minus business expenses, so everything we've covered so far feeds into this calculation. The more legitimate deductions you take earlier in the process, the lower your net SC income, which affects your Solo 401(k) employer-side contribution ceiling. Run the math with your actual numbers because the interaction matters. The right move is to open a Solo 401(k) if you don't have one. Fidelity and Schwab both offer them with no annual fees. Contributions for the 2026 tax year must be made by your tax filing deadline, including extensions, but the account itself must be established by December 31st of the tax year. Don't wait until April. The last deduction is the one with the highest dollar impact for most freelancers, and the one least likely to show up in a basic tax tutorial. It's the Section 199A Qualified Business Income Deduction. If you operate as a sole proprietor, single-member LLC, or S-Corp, you may be eligible to deduct up to 20% of your qualified business income from your taxable income. This deduction was created by the Tax Cuts and Jobs Act of 2017. As of 2026, it is still in effect, but it's scheduled to expire after December 31, 2025 unless Congress acts to extend it. Legislation to extend Section 199A is actively being discussed as of mid-2025. Watch this space closely. Here's how it works at a basic level. If your net self-employment income is $80,000, you may be able to deduct $16,000, bringing your taxable income down to $64,000 before any other deductions. That's not a marginal adjustment. That's a meaningful shift. There are income thresholds. For 2025, the most recent tax year with confirmed figures, the deduction begins phasing out for single filers above $197,300 in taxable income and for joint filers above $394,600. Specified service trades or businesses, which include fields like consulting, law, financial services, and certain professional services, face additional limitations above those thresholds. According to the IRS statistics of income data, only a fraction of eligible self-employed taxpayers claim the Section 199A deduction in the years following its introduction. That means a large share of freelancers who qualify are leaving a 20% income deduction unclaimed. The right move is to calculate whether you qualify before assuming you don't. If your taxable income is below the phase-out threshold and you're in an eligible business type, you almost certainly qualify. This deduction is claimed on Form 8995 or Form 8995A, and it reduces your income tax, not your self-employment tax. That distinction matters. If your income is close to the phase-out threshold, managing your taxable income through retirement contributions and other deductions we covered earlier can keep you in the full deduction zone. These strategies connect. Stack them intentionally. Before you go, a quick note on where to go from here. The deductions we covered, software and tools, phone and internet, professional development, retirement contributions, and Section 199A, are all legal, documented, and available to you right now. You don't need a complicated business structure to access most of them. You need good records and the willingness to actually claim what the tax code allows. I'm not a licensed CPA or financial advisor. This is general education for freelancers, not personalized advice. For your specific situation, especially around Solo 401(k) setup, S-Corp elections, or Section 199A phase-out planning, work with a CPA who specializes in self-employed clients. The cost of that consultation is itself a deductible business expense. If you found this useful, subscribe. We put out a new video every week built specifically for freelancers and independent contractors. Got a freelance tax or money question you want me to dig into? Drop it in the comments and I'll work it into an upcoming video. Next week, we're breaking down the new tax law every freelancer needs to understand before it affects your 2026 return. You don't want to miss that one. If you use tax software to file as self-employed, check out the affiliate link in the description. I only recommend tools I use personally.